Good afternoon, everybody. Terry Bell here from Bell & Company in Belfast. Another webinar that we're doing, which is part of our way of explaining the vagaries of debt in whatever form it takes. As we go through each of these subjects, we're finding more and more nuances, if you like, and it's creating new niches in what we're working in. This subject today, overdrawn directors' loan accounts, is becoming more and more prevalent and will be particularly strong next year as a subject in terms of insolvency, which is if directors are in that position at the moment and the company is under some sort of threat, they need to seriously get in order. We're going to talk in sort of conceptual terms around the subject, if you like, because there are so many complexities. What I'm finding from the webinars that we're doing, it's sad, if you like, but it's amazing how many, like I said, nuances there are within each of these little subjects. There are varying tactics, there are varying agendas, particularly what we're going to be discussing later on in this webinar. And it's very important that everybody is aware of who is at the trough. And there are plenty of people at the trough here. So directors' loan accounts, that's what we're going through. As I say, we're delving in a bit here. These are going to be my opinions. I hope I don't offend anybody. If I slight the profession, it's a generalization. It's experiences that we had. If anybody wants to have a go at me, please ring up me and tell me, or send me an email. There'll be some details at the end. This is a free webinar. We're giving information. If we get business from, we get business from it. From here, if there are questions, I will answer them on a free basis. There'll be an email at the end here, but it's not a selling thing. It just hopefully gives an example that we know what we're doing in quite a complex field. So directors' loan accounts, throughout of it, I'm actually going to call it a DCA. That's actually directors' loan accounts. So work with me on that. Directors' loan accounts, the technicals. DCA is what we use typically in the trade. Solicitors, insolvency practitioners, if you're tuning in. And typically on these, we have between 50 and 100 people that are listening. If I'm technically wrong, tell me. I'm not going into the statute. I'm looking more and more at the overall situation, as I say. One quick ad, not an ad really. Anybody that's joining us on the webinar will get our ebook, which we've just produced and written. We've still got plenty of copies in the corner there. So if you want the hard copy, just ask and we get those to you. I always say, if you can't sleep at night, it's a great read. No, it's a slightly different perspective, written in a light way. A little bit of bad language. If you're a sensitive disposition, don't read it. But I think it gives a different insight into debt, not just your technical approaches to things. So it's SME debt problems. You're welcome to it. You'll get the email. So just a quick introduction before we go full steam. We've referred to this as when the music stops. So everything works in businesses, as we know, pretty well until it starts to go wrong. Directors, DCAs, directors' current accounts, are particularly prevalent to this when it stops, because there is an asset there that an insolvency practitioner can seek to recover. You owe the company money if you're the director. So it's not specific advice. We'll gladly give that afterwards. That's fine. We can only go so far, obviously. We're not going to run a case for free, but if there's specific queries, we'll answer or endeavour to answer as quickly as we can. We're talking tactics, as I said, rather than specific statutes. Specific statute will leave to our legal friends and or insolvency practitioners. This is an overall situation that we take that overall view on things. We're dealing with DCAs, as I call it, DCA, Director's Current Account. And we're looking primarily when insolvency kicks in here, because that's when the problem usually becomes very noticeable. There are tax implications in terms of directors' current accounts, which I'm not going to go into. That's for the accountants to deal with and how best they cover their clients' tax affairs and everything else. And that's definitely not our remit and way above my pay grade. We're going to give an example here, typically of a case first, because it starts to give you hopefully a bit more context of how the situation arises and what goes wrong. And we're particularly reaching out to accountants because they're usually the ones that are left holding the baby when it goes wrong. So we know that directors' current accounts are used and abused by directors and usually mocked up one way or another with a dividend and or some sort of accountant's taxation provision a bit further down the track. Typically, an accountant say, right, okay, try not to do that, or definitely don't make it worse than that, or only go to a certain level. But very often, directors will live on their current accounts. It's not their money, it's the company's. We all know that. But we understand the situation that accountants sometimes face, and it's very difficult. And when it goes wrong, very often the finger's pointed at the accountant and or other professionals. That's not our bag at all. We don't care. We don't care who's done what. We're taking a picture. When it goes wrong, that's where when we come into play, as it were. So we've got this example. We've sort of protected the innocent a little bit, and we just talked in round figure sums here. But it shows how this can quickly mushroom if it's not gripped. And when it goes wrong, that's when it goes really wrong. So we're going to give you an example here, right? So in the year ended accounts March 2017, we'll say there was a director's current account balance of 50,000. So any accountant would work hard for their clients to minimize their tax position, get it covered to make sure we keep in every way out of the clutches of the revenue. So that'd be a dividend, whatever we're going to do, your accountant or an accountant will sort that out for you. Typically, accountants go, please don't carry on like that, because that's not an ideal way. But sometimes, we may not all believe this, but sometimes clients don't listen. They carry on the same way. So in this case, then, in 2018, there was a meteoric rise in terms of the director's current account. In the case we're talking about here, they decided, the couple that were directors decided to take out, I think it was about 60 odd grand, to help one of their children put a deposit down on a place in London. Commendable in one way, do it maybe a different way on another day. So again, the accountant's got this increasing problem. Once the directors get used to this availability of funds, if you like, then it's quite hard to wean back off. And that's not judging anybody, that's the way it is. We understand that, right? So in the next year, suddenly, we're booking holidays, going, buying other things, mopping up our tax with the director's loan account. So it's a self-perpetuating problem. And that was the last set of accounts instance. So there's a 200 grand director's loan account that didn't get mopped up. So they were the last figures prepared. Sorry, that did get mopped up. Okay, so, but then we go to 2020. The company went up the left, as we say. It struggled, it was failing. Accounts weren't filed. You know, it's the thing where they turn on the accountant. I don't want to file the accounts because why would I? Why do I want to spend the money? I've got enough crap going on here. I need to concentrate on myself, etc., etc. But it's for accountants. It's hopefully we're giving you a reason why they should do these accounts and also earn fees, because otherwise you leave it hanging. Incomplete records are an absolute joy for insolvency practitioners and the like, because it can be a perception of what the situation is. You can decide, for instance, we had a job recently where they only counted the debits and said that's all the director's current account. It's eye of the beholder stuff, a phrase I use later. Incomplete records, yes, they may be in that form, but incomplete records after the last set of accounts back in March 2019 leave everything up for grabs, and it's how it's perceived, how somebody else looks at it, and it's quite a dangerous situation. So you've got the last set of accounts back in 2019 said there was 200. We may have increased that. We don't know. The accounts were all over the place. And March 2020, a grey at best. And because of the incomplete records, suddenly we're open to somebody else's interpretation of the situation. Then from there to the date when the company went into liquidation, there was a 20-month window. So an IP will be working on the March 19 accounts. There's say 200,000 there. Then you've got all the transactions up to the demise of the company. Then they have a situation where no dividend was awarded because suddenly everything's out of control of the client, the director, and or the accountant. So you have a big window there. You've got a big window in terms of recollection of what went on, what was this, what was that, and you are in the hands of the insolvency practitioner. He may be the friendliest guy you're going to see when I want to put this company to liquidation, but we've just seen a case there where a liquidation happened 5 years ago, and because of reasons that I'm going to explain in a while, that suddenly has now reared its ugly head, and the insolvency practitioner's got it in his head that we owe £1 million plus. We owe something, but it's not £1 million. But because of that gap and that uncertainty on facts, prime documents, etc., there's a lot of room for manoeuvre here, particularly on the high end, on the part of the insolvency practitioner. He can throw an accusation at you, and with the reason that sticks, and as I'm going to mention in a minute, you're guilty. So then all the hard work comes in, but it still comes back to the overall concept of what we're doing here. So in this example, what we're saying is a DCA can get away from itself if we don't close it off properly or correctly record it and cover every base, it's open to interpretation and or maybe for that insolvency practice, abuse on their part. So the time is not a great thing in terms of what's going on in life. Very often clients will say to their accountant, so I've got bigger fish to fry here. I don't care about those, but this is potentially personal exposure. So that's how it needs to be explained to the dear client. So that's talking around it shows how the problem can manifest itself. And again, there's a little arrow there, our marketing department, they spent all day there trying to work out how to do that. So it's that 20-month gap, no dividend, could be 200 plus and whatever else went on after the March 19 accounts. So that's that position there. So what we're going to do here is, this is our perception of where insolvency practitioners are, because it's a moving feast at the moment. Insolvency practitioners, excuse me, put my teeth in, they are struggling in a minute because the courts are closed. If you look at the UK, just in bankruptcy terms, personal bankruptcy that is, there have only been 700 bankruptcies this year. So here we are halfway through November. Annually, over the last few years, there have been 5,000 on average. So everything is stalled, everything can be hidden away under Rish's Coronavirus Act, because you can defend yourself at the basis that your company is struggling because of coronavirus. So they're a frustrated bunch of people, as are solicitors who act in this field. And so they're pretty frustrated people, but it's pent up fury, pent up anger, and we have to be careful when Rishi does release them. In terms of directors' current accounts, insolvency practitioners typically see this as the lowest hanging fruit. You owe the company, you may have some assets. I want, as the insolvency practitioner, I want money, get it paid in now. And it's the easiest target to go at. If you've done any transactions under value, if you've put some money to family, everybody's suddenly under threat, because this is the lowest hanging fruit. If they can get some cash into the account, they can do more scrutiny of what went on. They can start to realise the assets for better prices. So usually DCAs is where they go first. And as I said, you may see the insolvency practitioner day one who says, "Yep, everything's cool." When he becomes the liquidator, he is then acting for the creditors. Something that is very obvious, but a lot of people miss. They think their new best friend is going to take all this crap away from us. But they very quickly turn, as they have to, because it's their job. They take that scattergun approach. We've got a case there where a guy basically ran off with a couple of $100,000, and then it's been opened, and he put some money to his son. He's got an ex-wife situation. He's got a couple of assets. He's got an ex-wife and a wife, and the insolvency practitioner hit them all with something. Okay, so it's to basically unnerve you, to take your eye off the ball. If you're guilty, you're guilty. If that person's guilty, you're guilty. But it's just keeping it back in. But that's very often a tactic. Fire it out at everyone, get everybody arguing, which they do. This isn't nice. You get a letter from a solicitor or an insolvency practitioner, you owe us 100,000, and you don't know what day it is. It's tough, and it's very pressurized. Our guys here are always under pressure, working diligently in everything they do, but we have to keep an eye on them because of what they do. It's a tough gig, but the debt and the pressures that come with it should never be underestimated. Something we refer to in the book quite importantly, which is the mindset when you're going into debt. Now, insolvency practitioners, especially, they are having a bad time at the minute because there is nothing going on. They're always after looking to secure fees. They run a business on that basis. Let's cut to the chase. That's what they're in business for. And not in there to do good for people or anything else. They're there to do a job and secure fees, which again goes back to, if the DCA is there and it's the lowest hanging fruit and they think they can go at it, they could start firing out statutory demands. Rishi's Act and the courts and everything else slow that down, but be very careful with angry insolvency practitioners. We assume, as I was saying on the previous slide there, if there are incomplete records, it's quite easy to take a view on something. It can be completely misplaced, but if somebody says, right, we think you owe 400,000 on a case, which we got the other day, you're guilty. You owe 400,000. It's then your job as the director and or the accountant to prove that isn't the case, which is why it's very important to make sure these accounting records are up to date. It's so important. It's not true. Loose records are a nightmare. In that case with the 400, we were quite vociferous in our response. In fact, we're actually a creditor in the liquidation, but we were deemed to be guilty, and indeed our side thought we were guilty. So we have to change that round. We must prove our innocence, and you have to do it in such a way that is absolutely nailed on. It can't be wishy-washy answers. It can't be trying to hide things. It's got to be straight up, you're guilty. It's not the good old English and UK law approach. You're innocent until proven guilty, other way around. It's similar to when the revenue come up there. You're guilty, prove otherwise, please. And that's the same sort of thing. And they're going back, sounding like a broken record, get these the accounting information completely up to speed so you know where you stand, and as much supporting document as you got. Any number of times we're finding that people just cannot prove their actual position, and therefore they're guilty because the accusation's been made and they can't prove otherwise. So, like I say, going on, again, broken record, incomplete records are there to be abused in the eye of the beholder, very typically the insolvency practitioner. And they haven't got to do a lot other than pull out the accounting records and say, I think that's what you owe us. And it's the other way around then, to try and defend yourself and fight your way back out. So that's insolvency practitioners, where we think they are today. They're struggling, looking at the lowest hanging fruit. Accounting records need to be right. And I'd appeal to any accountants, they've got their clients under a bit of pressure. They start to sort out their affairs and get them right so that when it does go wrong, which it unfortunately will, in many instances with the economy we're going to face in, say, 3 to 6 months, then you're in a better place to decide your fate, as it were. This is I won't call this interesting. This is a very big development in terms of insolvency work, and this is litigation funding. So we had a case about 6 months ago where a liquidation was undertaken 5 years ago, and every year the liquidator was filing the same report, nothing to report, with 150 grand of creditors, 150 grand of creditors. They suddenly secured, or a firm of solicitors approached them, they secured funding from one of these litigation funders, and they've come up as full tilt looking to get £1 million out of us, and they're throwing everything at us in terms of, in terms of the case. So what is typically happening there is insolvency practitioners, say 4 or 5 years ago, and any litigator wouldn't have had the funds to push this through. If it's a strong case, there's a strong asset and a strong chance of recovery of monies here, litigation funding is now available. And this is a game changer as we go into this recession. In the last financial crash, to all intents and purposes, we work here in Belfast, but work literally all over Europe. The situation was that the asset values got shot as well. This time, I think the asset values within Maine, especially if they're personal assets such as homes, will stand fairly steady. I think Savills were talking about a downglide the other day, but we should be aware, if we owe money or a client owes money and they have assets, this is what this is for. They don't give a monkeys, they're coming at you, and the solicitors will literally throw everything at you. As I say, it's becoming more and more prevalent as we go through in terms of the recession. Too early still because the courts aren't open. There's a main player in this, and it was amazing. And I will send this around to everybody. It was a share tip. I've got it somewhere. Put it down. No, it was a share tip in the Financial Times at the weekend, and a company called Manolet who are creating all these great, and they're good at what they do. You can't knock that. And they're creating all these connections, if you like, ready that if an insolvency practitioner thinks there's a case that can be verified and validated, then it's a good chance they will support the case in terms of funding. So if we think, if the insolvency practitioner thinks there's assets there and or they need a bit of litigation to get there, this money is now there and available. Manolet and Burford Capital are the main players, but I expect quite a few new players to come in here because the returns for these guys, I don't know the exact details, but they'll be very, very attractive. Manolet at the moment in England have got 110 cases, and they've got some serious stuff in the high courts going on. But this will definitely filter down through insolvency practitioners and their legal advisors and these things. So all that's required is a simple explanation of the case, and we can get on with it. Then, once the funding arrangement, we've yet to see a funding agreement, but we'll find one. they come at you all guns blazing. Like I said earlier, they're scattergunning. Everybody in their sites is going to get it. So they start to get some action. They start to get clients speaking off the record. They start to get clients panicking and saying things that basically aren't true. You do get liars, I know that, but very often under pressure, they will say whatever they think the liquidator and or the solicitor wants to hear. We see it any number of times because they're threatened with all sorts, etc. So, but they come at you full because they're funded. If they get this sort of support, they're fully funded. Just go at it. There was a case we looked at about another one 6 months ago, where somebody went bankrupt for about 100 grand, and there were 100 grand of fees before we got talking money. To how that happened, I don't know, but that's still open for debate. But they come full on here because they can and they will. But the key one on this is, right, the likes of Manolet and that come on board on the basis there's going to be a good return in a defined time. Yes, they're not short term. It's not a county court summons we get through and have a go at, right? Very often it takes years with the litigation, but the funders are very commercial. If our dear solicitor and our insolvency practitioner are going hell for leather because they've been given some money fees to throw at this job, they will go and get it. That's cool, get that. I'm not a communist. But Manolet and the likes of those want to return on their investment, and they want it fairly quickly. If somebody decides they should go at, they think if somebody's worth 200,000 and they go full at it and run up a 100 grand bill on it, but then it transpires they're only worth 150 and can only realize 120,000, suddenly the funder has a vested interest because he wants his money back relatively quickly, and he's not interested in low more litigation if they're not going to get their initial money back. So they become involved in the decision process. Thus, settlement, but it involves three parties. The liquidator is the name up front. He's the main guy. The solicitor's usually the driving force, with all the tools at his disposal, statutory demands, freezing orders, da-da-da. But the funder at the back wants their pound of flesh. And if it comes under any threat, they will let the insolvency practitioner know. So there's three parties involved. At the end of the day, there's a bit of a heady mix here because everybody should be working in the best interest of the creditors. Okay, so read into that what you will. But sometimes we have to remind any of our legal friends. So we've got the liquidator involved, the solicitor, and I think more and more prevalent as we go down the track is going to be the funder. So three parties involved: liquidator, solicitor, and important funder. It's not catching on like wildfire yet, but it will do. Anything that comes out of the States, apart from Donald, usually legal terms comes towards us. So it's a bit like the compensation culture and everything else. You know, so it's a bit less than the NHS are going to get slaughtered after COVID on all the litigation. Again, you can see them revving up. This is specific in terms of this particular niche that we're discussing today. So even if we have been in a position where the accountant has managed to get the accounts to look the part, awarded the dividends and everything else, if the dividends have been taken wrongfully because the accounts are the responsibility of the directors, then there's the chance that they can be effectively overturned. And if our action result in the demise of the company, there's other exposure, which we'll come into in a minute. So we've got to check that the dividend was correctly granted if it was used to mop up the director's loan account. Again, it's a technical one out there for accountants. You decide that, guys. I leave that with you. But we've got to work on the basis there will be a bit of scrutiny here when somebody goes through the account. So we've got I don't know, the client came with a stock figure that was wildly wrong. It leaves a bit of exposure there if under scrutiny, and after being checked by the liquidator that wasn't the case, then it can cause problems. If they were incorrectly granted in any way, it effectively can be added back to the director's loan account. It's a little bit more complex than that, but that's essentially what happened. So in that example that we said in the first year in 2017, March 2017, it was a 50,000 director's current account. If we said, okay, that's fine, we'll give ourselves a 50,000 dividend, and that wipes that out, that's okay. But did the company actually make that much profit? Did it have the reserves to do that? Very important that if it is going to go towards the buffers here, we have a little look back to make sure we've got all our ducks in line. And wrongful dividends, again, slightly in the eye of the beholder, because when a company goes wrong, suddenly everything can come under scrutiny. With COVID, we have the protection at the minute of the Coronavirus Act and all that sort of carry on. And there's a little provisioning in there in terms of wrongful trading, but it's not a lot of cover, especially if you've got to go back 3 or 4 years. If they start saying, see your stock figure then of 120, we think it should have only been 20. Again, guilty till proven innocent. So it's very important to just get this housekeeping in order, get the accounts up to speed, check dividends that were awarded, make sure they stand the scrutiny, and get those accounts right up to speed. They can then look at that. Did that withdrawal in that example there, taking that 50, that 130 and 200, did that ultimately lead to the demise of the company? And what it is, you're basically, the liquidator is basically making an assertion that your action by using the company assets like that led to the demise of the company. If you take 380 as they did at that point, it definitely contributed. So with that backdrop, he's got to then decide that how you as a director should be treated. So if you've deemed to have abused your director's current account and just treat the company's money as your own, it's not, but there is facility there to use a director's own account, that's a current account, that's fine, right? But if it's abused and that led to the demise of the company, then you're leaving yourself open to investigation for director's disqualification. The official receiver will receive a report from the liquidator at some point saying the director was fired, it was a bit of bad luck, COVID knocked us out, or they took 280 grand out of the business, they led to the demise of the company, and I think they should be investigated further by the official receiver, and then they would start proceedings, and then they can be quite draconian, some of these directors' qualifications. Again, if you're guilty as charged, then you're struggling, but a lot of this will come from assertions and beliefs of the liquidator. Armed with as many facts as you can to make sure you're okay, gives you a lot better chance to argue this. And we've done that on a few things. Typically, the official receiver, again, will come all guns blazing. You nicked all that money, you did this, you did that. If there are other mitigating circumstances, you want to get, going back to a phrase I use quite regularly, which is a rugby phrase, get your retaliation in first, okay? And this is where you've got to start understanding where you're going to go with this in terms of the overall situation if you're under threat. So if the business is struggling, you've got the landlord shouting, sorry, not the landlord, the property owner shouting at you, you've got any number of pressures all on, but you still need to get yourself in order first, okay? And it's very often, it's a cliche, but as they say on a plane, if there's problems, put your mask on first. Sort yourself out. You can't sort anything out. Any number of times we're seeing entrepreneurs, business women and men, where they do everything right, make sure every bit of wage is paid, run up great big credit card bills, forget to do the records, haven't got anything, off bigger fish to fry, and they forget about themselves. So get yourself sorted first. And this is just a very short, by no means exhaustive list of what you got to do. There we go. Retaliation in first. Get that DCA correct. You've got it. You can fight with it. I don't owe that. I owe this. This is because I got my act together. Here's all a load of papers. There's a box there, and everything. Get that retaliation first. Get your argument right before it even starts. We work on the basis at Bell & Company where we try and answer the questions before they're asked. And it's that sort of tone, which we refer to in our book, which everyone needs to adopt. What's going to be the worst here? Don't sit up all weekend and all night trying to work out every ramification, but just try and think, where will this go? What we're trying to do with this work we do here is get across the concept, understand the pressures that could come, understand the whole thing that you're trying to do here. It comes down to, if a liquidator is going to go through every transaction for 5 years to prove his arguments, so he can run up the big fee, be ready to counter it if you've got something different and get yourself right. You want to be arguing in whole terms. You don't want to be arguing the fact that somebody paid whatever, I don't know, school fee through the accounts, not right, but you need the whole thing there. You need the whole situation. The liquidator may say, you owe 400 grand, and you may say, actually it's 150, and here's why. So get that retaliation first, get your act together on it. Look at everybody should do this, nobody does. Look at your own asset and liability statement. Very, very important that and it sounds patronizing. I know what I'm worth. I know what I'm worth. Of course you do. No, you don't, right? You don't know it for the reason that if it was under attack and you don't have all the facts, you can't argue. Going back to that instance there, so we've got a case there where they've gone absolutely nuts and it's going, you owe us $1 million, you owe us $1 million, you owe us $1 million, right? Cool, dead on. We're only worth 200 grand. You're never worth 200 grand. They did more work. We reckon you owe 1.5 million. So our response is, hang on a minute, half-wit. If we don't owe you $1 million, we can't pay you $1.5 million. So stop what you're doing. We're worth 200. If you want to talk about that, we can do. Armed with that fact, that gives you a different position altogether. Okay. And it's very important. Know your own figures. You will know them. You know whatever your pension is. You know when your pension is due. You know the car values and house and da-di-da and buy to anything else you may have, but know it. Almost like have a wish list. If someone has to go, I suggest it won't be the family home. It might be the buy to let. It might not be the home. It might be the holiday let, whatever. But you have to get your act together so you know what the figures are, and they need to be discounted sensibly with two things in mind. If they're going to come at you for insolvency, okay, there's going to be a down value. COVID is yet unmeasured because we still got the benefit of the stamp duty holiday. That value will slip. Trying to sell anything in the second half of next year is going to be tough enough because cash is going to be king here. Another one that's very important when you're under threat is managing the costs. If you are bank to right, and you owe the money, you need to cap that as quickly as possible before they do the scattergun approach, before they start throwing costs at everybody. Get it sorted, hold it, work out how you're going to do it, because litigation costs a fortune. Sorry to my legal friends. Litigation is great for solicitors because it just keeps going. That for a solicitor to say, right, don't worry about that, we'll sort that out now, do it now. That's a bit like turkeys voting for Christmas, right? Manna from heaven from our liquidator, manna from heaven from his solicitor, manna from heaven, strange enough, from our solicitor. So managing costs, they can very quickly get out of tilter altogether and put the thing right out. If we're prepared, we've got our DCA together, we've got our asset liability, so we know our risk and exposure. Go to them early. I can get you, I might owe you 200, I'm worth 150, I'll get you 100. If you don't want it, cool, do what you want. You have the backdrop, if you're under threat, as does anyone under threat from debt, of petition of your own bankruptcy. Their problem, the liquidator and or his advisors, was if you do that, they lose carriage of the case and a new trustee will be appointed and it's a completely different ballgame. So it's that cost thing, is knowing all your facts, knowing where the case could go. Every case in what we do is different. Every case. We're giving a round robin sort of situation of how this could work. You need to create arguments, not to the extent, pardon me, not fatuous arguments, not rubbish, but you need, if there's arguments to be had, have them, right? Because you can't sit there and just be guilty, because if you're soft and you don't do enough and you're chatty with them and everything else, you lose all kudos in the case and they think you're soft. And if you've got the assets, it's easy. That's all they're going at. Okay, let's be honest, they're going at your assets. And don't forget, it's for the benefit of the creditors, or so it should be. Arguments to be had, have them, right? But make sure they do stand scrutiny, but get them out there. Going back, you've got retaliation in first. That's what I'm worth. I don't want you to charge a fortune here, and I've got an argument with you anyway. Okay, but again, going back to the next few years, I think the ability to raise funds is going to be absolutely imperative. Obviously, in the last crash, 2008, 2009, there was too much money, easy money about. This time, we can already see the big four banks tightening. We're starting to see, after the civils goes through and everything else, it's going to be tight as anything. There's not going to be a lot of money around. Mortgages, we're already seeing the likes of Nationwide requiring 20% deposits to buy things, whereas 9 months ago, it would have been about 5%. So we know the market's tightening. Be aware of your need to settle and raise money. And again, that's going to come from the works above. And it's getting this checklist right. So if you need 50 to 100 grand, where can I go? Is Aunt Doris going to give it to me? Is great Uncle Albert going to give it to me? Is the bank 100%? Are my mortgage company? You need to keep that availability of funds updated all the time because it's changing so fast. Cash in the second half, especially 2021 onwards, is going to be key. And as my senior partner used to say, cash flow in difficult times is the eighth wonder of the world. So just keep that in mind. Debt situations don't improve. If you don't take them on, it will come and consume you. So that's where we're going to with that. Then, if funded by the other side, it goes back to a three-party decision. So we need to be aware that that is the case. So, but again, all those things, we're just finding out as what's required in terms of any legal action as to whether people can just carry on and not tell us if there's a third party involved. And when we get that sort of information, we'll start to share it. But it's very important we understand it's a three-party decision. So there's your approach if you're under threat. Not nice, but get your house in order, and you are what you are. I often call it the sweaty box syndrome. Because you have your case, it's all rubbish, it's over there. You go to it when it goes wrong, when it hits the fan. You open the box, you deal with it, shut the lid, get on with your life. You can only do that if you've got your act together and those points are covered, and you know as much as you can. You have a route to take. Like I say, every case is different. It changes as you go down the road, for sure, 100%. Things come out. Somebody may die. The liquidator may hear of that, and you're going to be the beneficiary in the will. We've seen that any number of times. So there's a fair route to get it, but just nicest way, get your act together. So that's us, relatively short and sweet. Quite a niche market, as it were, and subject, but it's going to be a very, very, very important one going forward. And when Rishi releases the dogs, as I keep saying, and gets rid of his Coronavirus Act, it's going to be pretty tough out there. Nothing that we celebrate. It's what we do, but it's a bit like being a financial undertaker. It's not something we're happy about, but it's what we do. So I'm not going to apologise. I spent 2 months after COVID came, and sorry, it's going to go horribly wrong here, but no, it's what we do. But I would say we're really good at what we do. If you want to have a chat with us, ping. If there's any specific questions, just ping it to that email there, trb@belcomp.co.uk. We'll gather it up. Might take us into next week because I'm traveling the next couple of days, or within the restrictions of COVID, obviously. And I'll get back to you very early. If something's urgent, there's a phone number and there's our website, which our marketeers always say, make sure you put the website on so that they get their hits and all that carry on, so they can show how good we are. So you're very welcome. Hopefully we'll all be okay through this. If there's debt problems taken on, have a look at the book if you get a minute. I think it's not hard read. It's not too technical. That's not saying we're thick, but I think it's a lighter read, and it's how you need it. And a lot of the things we're discussing here are the same that goes on. So thanks for your time. Good luck. Stay safe.